Welcome to the Fintech Founder Journey, the podcast that explores fintech and the founders that power it. We look at how to build better fintech products, better fintech businesses, and how to work on yourself to be more successful in all that you do. I'm your host, Mike Scott, and I'm also the co-founder and CEO of Nona Digital, an expert firm that accelerates product development for fintech and blockchain startups. In today's show, I'm joined by Andries Smit from Upside Savings, and we'll be talking about his journey and insights as a fintech founder. This podcast is sponsored by ourselves, Nona Digital. Working with us to accelerate your fintech or blockchain product, you get access to deeply skilled and experienced designers and developers that have been building products for a long time. You get the benefit of a team that is big enough for no key person dependencies to exist, but small enough so that you're always close to the principles. And you get the benefit of our reusable component library, which means that we're able to launch your product sooner than anyone else could at a comparable standard. To get in touch with one of our principals directly, head over to nona.digital to book a consultation. And now onto the show. Today, my guest is Andries Smit from Upside Savings, who is a seasoned entrepreneurial leader and has worked across startups and large corporations in many roles, and who brings with him a wealth of experience. He's also a prolific investor, so he understands the game from both sides. And his current focus is as the founder and CEO of Upside Savings, an early-stage startup offering people cash back in exchange for their data and offering businesses valuable insights via reports through their APIs. Welcome, Andries. It's good to have you on the show.
Thanks, Mike. Thank you for having me.
Yeah, no worries. So let's just set the stage. Describe what the business looks like today. Give me any metrics that are public. Tell me where you are in the stage, just the way you view the business. Paint the picture for us.
Yeah, absolutely. So we founded Upside back in 2020 at the beginning of the year. So if you like, we were in a private beta state until August. We've literally just now, a couple of weeks ago, went live with our first production client. So, very, very early stage, what I would describe as just launched API business.
Cool. And let's get straight into that, what you just said right at the end there. So just launched API business. APIs are not new, right? They've been around for a long time, but I think they've kind of become, mainstream famous through fintech. They're powering the fintech revolution, evolution, movement, whatever you want to call it. Talk to me about, when we spoke, you described Upside as, we have a mobile app, but we've always been API first from the beginning, from the first inception. Talk to me about what does that actually mean? What does it mean when you say we're API first, and why did you take that strategy?
Yeah, absolutely. 2 points in there, which I'll allude. So the fact that we are an API business, but we have an app, is simply a manifestation of whenever we build a business, I believe in testing the next most important hypotheses. And in our case, it was, would people share their open banking data for effortless cashback? That's a big assumption we made very, very early on. Because you get quite a binary outcome when it comes to anything data. People love it or hate it. It's a classic Marmite situation. Now, we build an app and we use the partner to do that very, very early in our journey, because that's sort of you don't pass go if you do not prove this hypothesis. But it was just that. It was a test to prove that hypothesis. So we always put that to one side. And therefore, even in the app we built, it was built on a basis of built on top of our APIs, because we knew that was going to be the end game.
Right.
The second part of what you've mentioned around APIs and being sort of inherent to the fintech and actually, I would go wider than that, the financial services world, is actually right from the inception. If you go back decades, financial services have always been built on layers of technology. You have the network layers, you have the infrastructure layers, you have the clearing layers, et cetera, et cetera. So actually, it might not have been called APIs, but this notion of a layered stack in financial services is as old, exactly, as old as the industry itself.
Yeah, 100%. And I think that's important, because that's why I said they've kind of become famous and well-known, but they're not new at all. And I'm seeing kind of strange things on LinkedIn. I don't know why it bugs me, but I see comments on there around finally APIs being used. And it's just like, what are you talking about? APIs have been used, for a long time with probably trillions of transactions,
I think what has changed is the interoperability of it, right? So if you go back 3 decades, then you were stuck. You were so integrated into a specific network or a specific protocol, it was impossible to move. The one thing which I do think has really become fundamentally different in the last 5 years is the fact that the mindset and the technology are now such a case where you can just swap things in and out. And for me, that's really what the word API just personifies, really.
So you mentioned open banking, right? Which is a term that's being used a lot. It's revolutionary. It's changing things. I spoke to a founder this morning in Australia who has just launched a great business. He's got some investment. He's flying. And he just said something. He's like, Mike, I just couldn't have done this a couple of years ago when the open banking frameworks didn't exist. And the open banking framework in Australia has now opened up an entire suite and opportunity of businesses. So is your business one of those businesses? Is your business one of those businesses that just simply would not and could not have existed in your case, it's UK-based, but sort of pre-open banking as a thing? And if that's the case, talk to me and explain to the listeners what open banking is in the context of how you use it and why it has enabled business models that just previously didn't exist.
Yeah, 100%. So the first part of your question, yes, we could not have existed without open banking. So we are a long line of innovators that benefit from all the giants that came before us and unlock this opportunity. Open banking, without turning this into a massive history lesson and keeping it quite short, but open banking really stemmed from the financial crisis back in 2008. Governments all around the world recognize that the banking systems are really at risk and we need more innovation in it. We need to systemically unlock this. Now, of course, as you would expect, it then took nearly a decade for that to then become legislated and really into proof. Yes, in the UK, the early tremblings of that started back in 2014, but it wasn't really until 2018 where you could actually call open banking a thing, where you could log into, there was set protocols, most of the large banks were part of it. It was actually workable, right? Now, what it really means is it's actually a piece of regulation which says that the banking transactions belong to the actual person, the actual end consumer who made those transactions. It's actually their data. And therefore, that person has the right to give any other third party access to that data. Now, they could choose never to do that and say, this is my data, stay away from me, don't talk to me. However, we are seeing more and more use cases where it's actually quite compelling for you to give access to that data. Here's a classic few examples. Instead of sitting and spending your entire weekend doing your taxes every year, you might actually just with 3 clicks give your accountant access to your bank transactions, and voila, they can do their job without spending hours and hours on the phone and back and forth on emails and explaining that. Another example is you might have 7 bank accounts and 3 pensions and God knows what else. That's very painful to get your head around it. So we had a classic trend of aggregation use cases. Literally a website, you log in, you plug in all your bank accounts, it sucks it all in, and then it shows it back, the information back to you. Now, our use case specifically is saying, if you plug in your bank accounts, then you don't have to go through all the pain of always clicking on a link to get a discount or an offer or cashback. You don't have to go search for promo codes. All of that friction is just taken away for you. As we spot that you've spent at the right retail partners, the cashback just appears and it literally just gets pushed into your savings account.
And then in exchange for those rewards, you've gotten permission from those users to then take that data, compile it, and sell it to vendors, to merchants. Is that correct?
Just to be really clear, we never sell anybody's data. We use the data to make the product even better. So here's practically how it works. All of our data today is being used. It's being exploited to spam our feeds. No matter which social media platform or search platform you use, even your email, you are constantly being bombarded on the basis of all the data that's being collected around you. And you get very, very little value of that. And most of the time, those things are not relevant. What we're suggesting and what our users are opting in and giving us that permission that you described on is to say, if you connect your bank account, under the regulations in open banking, we get up to 2 to 3 years worth of backdated data. So we can immediately see Andries is a coffee drinker. Not because he looked at fair trade beans on Facebook, but actually
But because he
he's in
bought coffee. Yeah.
yeah, he's in a coffee shop every second day. Now, therefore, within 4 seconds, when Andries logs in, we can show him a coffee offer. Super relevant, super to the point of his existing spending behavior. And that's what our users love. And that's how we use their data. We do not package Andries' data and send it to a bunch of coffee shops. We simply create that matchmaking. So think of us more as a marketing platform where coffee shops can come and say, we really want to give upside to coffee lovers and those guys that are really, really keen on our brand. And we facilitate that transaction with the data.
So it's actually monetizing the user's data, right? Which is the beginnings of, I guess, what the argument is against Facebook, Google, and even Amazon, I guess, which is like those platforms are not free. You're paying for them with your data and they're making gajillions of dollars from it. And I guess, correct me if I'm wrong, but what you guys are trying to do is saying, you know what, this data is actually yours. And you should be the one that's generating value and revenue from this data. And we're providing a marketplace or a matchmaking service, which actually rewards you in the form of cashback. Is that a fair summary?
100%, right? There's 332 billion pounds a year just from the UK that's being shipped to those enormous data companies that you reference, right? $1 trillion companies in their own rights. And our fundamental argument is actually we should put that benefit from people's spending and shopping behavior straight back into their savings account. Literally, that's where the name Upside Savings comes from.
How does, at the risk of going down a bit of a rabbit hole, and maybe we can go a little bit down the rabbit hole, but how does decentralized identity factor into your thinking here? So, you've built a business model, which is a sound business model. It's got monetization models. It's a centralized business. It's a traditional business structure with a clever idea, but it's traditional, right? It's a sound principles business. In the world of blockchain, there's a whole decentralized equivalent that a number of companies are trying to work around with data sovereignty. So you own your data online, but to the extreme degree, and you decide who gets access. So for the users, what I mean by this is instead of having, using Facebook or Google to log into websites, it's kind of the reverse. Is you would own your identity and you would allow Facebook to access your data, or you would allow Google to access your data, and you would control and revoke that data. That's a decentralized system. I'm just interested in how you are thinking about decentralized data, decentralized identity and data as you go about building this business. Is it factoring into your consciousness? Is it a completely separate thing? Am I getting the two things mixed up? Just talk to me about how you're thinking about that.
Yeah, I think at a philosophical level, we're in alignment. We believe about that data sovereignty as well, right? The drive towards that. Where we are different is we take very much an observer approach to the world of DeFi at the moment, as an example. We do not believe yet that the use cases and specifically the technology implementations make economic scale and sense for us. And I'm saying that very, very personally for us as a business just yet. I believe the market is hot in exploring loads of things. My personal humble opinion is that we've not, as an industry, found and put our finger on the one thing that is going to make it. There's a lot of hype, as there always is in the beginning cycles of the hype curve. All the conferences are talking about it. You mentioned social media. Everybody's all over this. I just think practically on the ground, it's a very big risk for a young startup like ourselves, where you have very limited resources to just shift one way or another. The way we think about it very similarly is, if we don't need that cutting edge technology, then don't use it. And when the need arises, we need to be ready for it. So it's that two-pronged mindset that we hold always.
And back to your API analogy, at the time you need it, there'll probably be an API that you can access to leverage your core business, right? You probably won't need to build that out your own, which is the power of APIs. It's what you're doing for merchants and vendors. There's an amazing TED Talk that I rewatched. I think it was from 2015. I watched it yesterday. Someone reminded me of it. I can't remember who it was. It's one of the sort of founding fathers of startup philosophy. And he talks about, a massive study that he did. It's got like 7 million views or something. And it's a massive study that he did around the primary reason that this particular guy sees for startup success, not failure, but success. And it surprised me when I watched it a few years ago, and it kind of reminded me now. And the primary reason, according to him, is timing. right? So your team can be great, your execution can be great. These things are all fantastic, but the actual thing that makes the real startup succeed is timing. With that in mind, my question to you is, why now? You've had quite a colorful career. You've been in big corporate, slow-moving behemoths by the looks of it when I looked at your profile. You've been in rapid startups. You've invested in startups. And now this. Now, why this now? So apart from the open banking being a thing, unless that's the answer, if it's that simple, but why now? The timing question is interesting to me.
Yeah. So just before I answer that, I absolutely and wholeheartedly agree with that point from experience. So back in 2008, we tried to start a quantified self business when the iPhone 3S came out. And we horribly failed because we were literally too early. We expected things from the technology. We expected things from ourselves. We expected things from the data, which was just impossible. And to be honest, I think we were 10, 15 years too early. I learned with the skin of my backside that timing is critical. And I think at that stage, the one lesson I wrote down in my little journal after that experience was, don't be as arrogant to think you can create waves.
Yeah.
Right. You might be lucky. You might be the one of these beautiful Times Magazine front page cover individuals who do that. Phenomenal.
Yeah.
But guess what? There are only 10 or 20 or 100 of those in history, right? So what I've changed my mindset is just spot the wave and really, really get on the surfboard early. So I've personally been looking at things like open data, very early in my career in corporate life. I always felt just that as basic stuff, data can help take friction away. It's no more glamorous than that. People always beef it up to be a lot. But first principle is, if I know you, I'm not going to ask you stupid questions. I'm not going to irritate you with friction. So first principle was always in our search, and I'm now going back to 2014 to say, how can we do that? The second principle then is, of course, how can you actually take it into real value? So a different product, more relevance in its feature set or in its terms and conditions and so forth. And then third level for me around this, of course, is then actual monetization, cash, right? If I can make it as frictionless as humanly possible, I can make it specific to you, then boy, oh boy, can I put some money in your savings. Now, the answer to your specific question, why now, is I personally felt that 2018 September was when I looked at open banking for the first time and felt actually it's more reliable than not. The connections last better than not. You can connect more accounts than not. And it really, you can see that even in the open banking implementation entities user stats, from 19, a few 100,000 to 1 million at the beginning of 2020 to 2 million at the beginning of 21 to now 3 million only 6-7 months later. The adoption, the user adoption for me was the measure that it's now is the right time.
So and then of really, course, I want to dig into that, Andries. Sorry to interrupt, but that's really interesting because I think I was listening to Fintech Insider. I think it was on Fintech Insider last week or even this week. I don't know. And they were talking about the education piece, right? So even people listening to this, I'm guessing most of them, they might have heard the term open banking. My guess is they don't actually know what it is and they probably don't trust it yet, right? Yeah. And I'll admit, we've just, we're in Australia. We've just recently bought a home and I was equally impressed with the process, but also I kind of laughed at myself because this is what we do. I'm in the world of fintech. This is like we build stuff for companies, and in the mortgage application process, the bank that I'm using asked for access to my bank accounts, and there was like a moment of going, "Ooh, I don't know if I trust this," and then I kind of laughed at myself, and I was like, "Come on, Mike, you guys are literally building these integrations," and I just had such a weird moment of like there isn't mass adoption of this yet, and I guess my question that I'm getting to here is, I know it's very, very early days for you guys, so maybe you don't even have an answer to this question yet. But are you finding that you need to educate people because the trust levels are still very low about giving access to my bank account, right? Like I'm giving this company access to my bank account because that's how it's received. It's not being received, oh, there's this open banking, totally secure layer that I'm accessing. In the non-educated user, it's like I'm giving this company access to my bank details. Have you, as I said, I know it's early days, but have you experienced it's not a friction, but an aversion to clicking the authorize button? And if you have, how are you thinking about approaching that from a user perspective?
So actually quite the opposite. We're seeing conversion rates of over 60%. So more people are opting in than not.
They're not. Amazing.
And I think, I've got a very different view when it comes to trust. For somehow, when we speak about trust conceptually, and I say this with my corporate background, right? We sit in these rooms, we're very clever, we think through this, and there's massive consultancies that do these things on trust. Trust is a very interesting thing. People confuse it with time. You trust something that is longer than time. Now, time is a variable. Don't misunderstand me. But people make trust-based decisions in split seconds. You meet somebody random at a networking event, you could, within milliseconds, decide, oh, I like this guy or girl, and shake hands and get into a chat. Others, you just literally walk past. What is that? I think the human interconnection on that is very different. You go onto one website and you immediately buy from them. You don't know them from the stone outside, but you've just given them your credit card details. Others, you go on and you just leave. There are so many. I think there are millions of variables that go into our little trust-based decisions. The biggest one, I think, is context. And by the way, when a user experiences open banking, it's not like they go into a big door that says you are now entering open banking. The experience is actually quite flawless, but it needs to be contextually relevant. So as an example, in our experience, it's one screen where we explain to a user that first and foremost, if you connect your bank account, it means we can automatically spot your cashback transactions. And therefore, you don't ever have to click a link or copy a promo code. In one sentence, they get it. Now, based on all those other millions of variables for trust, they might or might not trust us, right? But the exchange, that compelling exchange, is quite clear. And we're seeing it's other things that people confuse. They think this is a demographic thing. So many times I hear people say, yes, but the younger generation is more trustworthy with their data, or more give away their data. I have a very different opinion. I think young people are way more switched on with their data. They might share more, but boy, oh boy, are they on top of their data.
Aware. Yeah.
Exactly. They check you out. They actually understand. They check in with their mates whether you can try and test some different things. It's a much more savvy a group of people.
Yeah, super interesting what you said there. I love what you were saying about trust, because we don't understand it. We, as leaders in businesses, we work very hard to build high trust environments, psychological safe environments. And I actually did a talk literally on this to some entrepreneurs last night. And it's actually very difficult to pinpoint how you do it. I kind of found myself at a bit of a loss for words, which doesn't happen often with me, but just going, it's hard to explain, guys, but and you realize it is actually quite difficult to explain. There are certain things you can do, and there are definitely things you should not do, but it's extremely nuanced. And it's great. I really enjoyed that answer. I want to ask you something which might sound quite sort of simple for you, but a lot of our listeners and a lot of people that follow founders, there's that first thing between that first little space, that awkward space between deciding, okay, we're going to do this. Like, I've got this hypothesis, we're going to do this. There's this awkward space between that decision and actually starting to build the thing. Talk me through like the space in between. I don't know if it was in September 2018 when you actually decided this, when you did open banking, but talk me through like, okay, I'm going to do this. And you spoke to wife's partners, whatever the hell, and you actually went, I'm doing this and quitting my job and whatever. Between that decision and actually taking the first step, what was that space like, and what was that first step?
I should calibrate here that I believe starting a business is like any other skill that you acquire, and therefore it becomes much, much easier the more you do it. Upside was my fifth business. In one of my previous businesses, I completely lost everything. Like literally, it was a wipeout. Now, when you've had that previous experience and you've been wiped out, and you know that you don't die, and you just get on with it the next day, and you sort out cash, and you can survive, and the sun shines the next day, then actually you're much more ready for taking that leap, right? So I just needed to calibrate that, because it's like everything. The first time you jump off a waterfall, you're scared out of your mind. By the 50th time you do it, you know what to expect, and you just jump, and that hesitation that you describe is much, much less. My key reflection, if I take all of that into account, and especially now aimed at first-time founders, is, you need to very quickly get to the point of just doing it. The longer you sit, the harder it becomes. You standing at the top of that cliff, jumping off the waterfall, the longer you stand there, don't look, the old saying from don't look down, don't think that is the problem, right? And what I see most, people that are friends of mine, very, very, what I would even describe as entrepreneurial friends who just never made the leap and who are stuck in the day-to-day, is because they are overthinking it. They have been sitting on the idea for too long and then just didn't do it. There could be no better advice than just do it, right? Give it a go, give it a try. Don't overthink it.
Simple, but so difficult, right? Like, it is simple. It really is, but it's not easy.
But the one thing, Mike, I would honestly, and I say this to each of the people I work with on a mentor basis, it's like the first time you're going on a ski holiday. The first ski holiday is rubbish because you're falling everywhere. You are bruised and bumped, and you're cold, and your gear isn't correct, and it's just crap. But you don't go skiing on the first holiday because it's only ever going to be one holiday. You need to think about the 10th skiing holiday. You need to think about the end outcome where you go to the chalet, and that's just what you do every winter, and it's amazing and it's wonderful, and you have all the nuances of the glue wine and all that kind of stuff. Now, with founding businesses, I really encourage people to think about the first 1, 2 or more in that kind of way. Don't put your life's identity on whether you're going to be successful the first time. Man, you don't do that you don't walk up to the football pitch and think you're suddenly in, the world championship.
Yeah, I mean, what's the stat? It's one of these sort of stats that are made up on the spot, but I'm pretty sure there's truth to it. But I've heard it too many times for it to be non-truth. But apparently, the average age of successful founders is something like 45 years old, and the average number of businesses that a successful founder has been through is like 4. So it's kind of like, the problem is the media hypes like 25-year-old billionaires that went from 0 to 100 billion in 9 months. But because they're fringe cases, that's why the media hypes them, is because they're not common. They are the fringe cases. I agree 100%. And I think that staying power is equally as important. But I want to change gears a little bit. So Crunchbase tells me that you guys have raised around $2 million. It's Crunchbase, so it decides what to put in there, and it tells me that it's sort of roughly over 3 seed rounds. And I guess my question that's come out of that is, did you guys bootstrap to build an POC or an MVP, or did you go and raise some seed money beforehand? Like, talk to me about the money side of how you got from 0 to a POC or 0 to an MVP in the context of raising capital.
Yeah, spot on. Again, the one thing I would counsel here is, man, oh man, there's so much advice and guidance on fundraising out there. My one word of caution is, it's scrappy as shit, right? So as a founder, you go through these things. It is not a little linear process. It's not a 1, 2, 3, 4 step thing. It just does not work that way. The publications and stuff out there is, in my opinion, they're trying to give you the common thread, but think of it as a textbook, right? It ends the moment you walk into real life.
Yeah.
Now, our personal journey, we did start as a bootstrapped company. So I put in money, and my co-founder as well, just to get us going. Fintech is usually more expensive to build up front because of the regulatory requirements. And therefore, you can't just, when you're talking about other people's money, right, which we are, and other people's data, you can't just whiplash something out there and see how it goes. We have a duty of care to make sure that people are protected literally from day one. That said, you can still do it scrappy. You can still do it on the cheap. But basically what happened is I then reached out to my immediate network. And we were blessed with loads of people that chipped in. We raised a good £200,000-300,000. But also, when lockdown happened, and in the UK specifically, there was a furlough scheme. One of our investors came to me and said he runs a software business. He's got engineers, really fantastic people that are now going to sit bored at home because they've been furloughed. Do we want to use them? And we struck a really great sweat equity deal. That was completely opportunistic. Nowhere would I have sat down and said,
exactly. And right now in the market, I mean, you must be thanking your lucky stars there, because in the current hiring market with developers, I mean, there's such a shortage, and I think that's the point, is that you've got to, you said something sort of almost by the way there, where you said you reached out to your network. And I think this is a big part of startups and the scrappiness in the early stages. Who do you know? Who can you call on? Who can you leverage? What can you leverage? Like, that network part of it is, as Naval Ravikant likes to say, it increases the surface area of luck. It's actually not lucky. It's deliberate. Cool. So sweat equity deal. You guys got the product built. Did they get you all the way to MVP, or did they get you to POC? Are you still working with them? Like, talk me through that process.
Yeah. So with that model, and again, this was a fluke, right? This was only because of coronavirus that happened. We went from 3 people to 17 people in like 4 or 5 months, because the infrastructure was just there. They literally just walked in. The team was ready. That meant that within 4 months, we had a fully fledged FCA regulated app with real people, real money, real e-money wallets out in the market.
Amazing.
I mean, it just
Amazing.
We blitzed it. We worked with that company for 6 months. They are still investors in our business. They are phenomenal partners to us. I would caution that you need to make sure that you pick the right partners, especially in those situations. I knew that company and the founder of that company for over 5 years. It was not an unknown commodity to me. They had a fantastic reputation. I've worked with them before, and so forth. So it was a natural match. It came from that close network. But I'm of a very, very, very clear mind about dedicated people, co-located, our own team, especially when you're building the core of your company. So, and they were very gracious. They understood that, and therefore they spent 6 months with us. But over that time, the mission was always, we're going to bring on our own CTO, our own engineers, our own product team, etc.
Yeah, absolutely. And I mean, hopefully it comes with some weight when I say I agree with that, because I run a business that builds software for other people. So you might think that's counterintuitive, and it's absolutely not. We believe very strongly that if you're running a tech business, you need to have at least your core team in-house. It's critical. We exist to accelerate and bolster what you're doing, but that core team, it needs to stay in-house. And look, you can be successful. We're actually working with a client now whose previous business he built and scaled and exited at very large numbers. And he never hired a single product person. He never hired a CTO. He never hired a developer. He never hired a designer. That's rare. And it's very difficult. And to be honest, I had a long chat to them. It was fascinating, because most most sophisticated investors, venture capitalists, etc., they're going to want to see your tech capability. They're going to be like, you're building a piece of tech. Show me your tech chops. It's fine if you're working with some partners, but I want to see your CTO. I want to see your head of engineering. I want to see your main product guy. And you need to be able to have answers to that. So I agree completely. Work with your partners, but try and build that core team, that the IP sits with that core team, because otherwise you're putting yourself at risk. And I hope that it comes with weight when I say it, because we have a business that is almost doing the opposite of that, but they do coexist very well, actually. So I'm conscious of time, and I want to move on a little bit. I guess the last thing I want to ask you about is a total change of gears, but it was in our pre-interview. I just loved the little thread that we went on, which was you made quite a big statement, which I kind of loved, and I've been thinking about it, which was something along the lines of, we haven't actually seen a single fintech break this B2C model yet. And we've got some massive valuations in the market. We've got some massive acquisitions happening. And I want you to just talk me through, firstly, if I butchered that, please feel free to correct what the statement was. But I'd love to just talk through what you meant by that. And, we're seeing Revolut at astronomical valuations. We're seeing Square, which is a fintech, acquire Afterpay at 38 billion Aussie dollars. I mean, these are monstrous valuations. Yet you feel like we haven't broken it yet, and that maybe the market is a bit frothy and giving valuations on future earnings. So just talk to me about your whole mindset around that.
Yeah, spot on. So just to clarify, I think in the B2B space, so people like Stripe and so forth, that's true value, and you can see them scaling differently. So again, if you think about financial services in these layers, the layers of the cake, at the core of it is where is the networks and then the infrastructure and the clearing. I think in those layers, the valuations are probably true because they have enormous scale and new technology. My comment is really when you get to the outer circles of that financial services layer cake, where it's about the use cases and very specifically the D2C use cases. So the man and woman on the street. Now, my comment there was very specific around if you were to map today who John and Jane on the street are actually using these neo fintech services, and I include, banks and wealth techs and so forth, then actually, in my opinion, you're only striking 10% of the populations still. I believe that mass market, and I ran D2C fintech previously, so much of the industry is on that top 10% of wealth customer. The people with already a lot of money, and we as an industry are extremely good at moving their money from one pocket to another and giving them next shiny tool and so forth, and they flush left and right and they add a little bit. I bet you if you take the top 15 fintech apps in the UK and you drew Venn diagrams, they're going to very, very similarly overlap. That's really where I'm coming from. Now, right. I think that will change. I think in the next decade, we will see use cases which make sense at a mass market level. When we did all of our customer research, the realization was John and Jane on the street, they're working really hard to provide for their families. And fundamentally, their money solution to life is, I'm going to work harder, I'm going to get a better job, I'm going to earn more money, and then ... Then I will have savings. Then I'll have a pension. Then life will be better. Then I won't struggle. But until we bridge that gap, then we're not going to get them onto that flywheel of wealth. We're not going to get them into savings for the future. We're not going to get them into retirements and so forth. And that's why globally, governments still today intervene. That's why they force us into national insurance programs. That's why they force pension policies. That's why they force your employers to do auto enrollment into pensions for you. It's because of that disconnect in the mass market.
So just a quick answer to this question. So do you think the fintech valuations that we're seeing at the moment are a bit frothy, a bit overpriced? Or do you think they're just sort of taking an educated bet on significant future earnings?
Look, it's how long is a piece of string? I think there are fundamentally frothy companies. I just yesterday on LinkedIn, I saw, I will not name this company, but I saw a company raised at a £500 million valuation, having gone from 1,000 to 15,000 customers. And this is a D2C business.
Yeah.
That is extreme. It's really extreme. Now, again, the smart, very, very smart VCs back that business. They probably have insight to that business, which I don't, and vice versa. So you'll have to ask them. But I just look at that cold, and I just feel that's quite extreme. Bells ring similar to the late 90s.
Yeah, we're seeing some crazy numbers. I mean, FTX. I don't know if you know FTX, but it's predominantly known as a crypto exchange, but it actually does all kinds of commodities on the exchange. I think they're only 3 years old or 4 years old. They've just raised $900 million off an $18 billion valuation. And, it's an incredible business. It is an absolutely incredible business, but there's big numbers being thrown around. I mean, we're working with a couple of very, very prominent African fintechs it's really exciting because they're raising numbers that we've never seen in Africa before. They're raising Sequoia Capital numbers, which is fantastic, and they're delivering, and it's really great. It's super exciting to be a part of this at the moment. Andries,
sorry, just one thing. One thing I mentioned to somebody last week is just be careful that raising funding is not treated as validation of your business. So many founders I see where they think the goal is to raise money. Yeah. Actually, the goal is to drive traction. Right? If you can raise great money on the back of your traction, phenomenal, then you deserve it. But don't be fooled into the space where just because you secured a 2, 3, 5, 10 million check, the business is successful. And it's hard, right? I struggle with that every day. It's not easy.
Yeah, those are wise words, because there's a culture of raising equal success. There's a culture of celebrate the raise. I saw a great post a while ago saying, why don't we celebrate businesses that didn't raise? Why aren't there headlines of companies that are doing well that have never raised? And it's a really good question, because that's actually more difficult, right? Like, we've never raised, we're independent, and it's an amazing feeling, and it's amazing accomplishment. I have founders on this podcast that have built very, very, very large tech businesses that have never raised money. And I'm like, why aren't you in the headlines? Because that's actually more impressive, and actually it's more focused. Not to say that raising is bad. Obviously, there's a time and a place where raising makes a lot of sense to accelerate growth and accelerate traction, to your point. But raising is not the end goal. Raising is the fuel that helps you with traction and helps you scale. Andries, we have to sort of start wrapping up. So I want to hit you with some rapid fire questions. So these aren't like long questions, just quick ones. So first thing that comes to mind, what scares you in business?
Running out of cash.
What content are you consuming currently?
Mostly retail.
What is the last book that you read cover to cover?
Let me look at my book, Atomic Habits.
Oh, James Clear, one of the best books ever. It's right there. There it is, up there. I've gifted that book. Phenomenal. He's got the best newsletter on the internet. If you don't subscribe, you should. It's fantastic.
Love it.
What is something that you are doing in the next 7 days to improve either yourself or your craft?
So non-business related.
Whatever you want, however it lands. Business, non-business, personal.
So we're issuing our first white paper. So that is a first for me. I've never co-authored a white paper. So scary as hell. Exciting.
It's been really great talking, Andries. Of everything we've spoken about, we jumped around quite nicely. I like to jump around. It's good for my brain. But we've covered a lot of stuff. If there's one thing that you would want the listeners to take away with them from today's discussion, what would that one single thing be?
Just give it a go. If you're serious about starting a business, don't hesitate. Don't overthink it. Just give it a go.
That's very James Clear, right? Just start. Just take the action. Andries, it's been super cool, super stimulating talking to you. I love your level-headedness about this. I think you've given a lot of sage advice. I can tell you've been there, done that, which is great. Do you like to be contacted or followed? And if you do, how can the listeners best contact or follow you?
Yep, please. That would be great. On LinkedIn, you could just find me, Andries Smit. And then on Twitter, I'm at Dries Smit without the AN.
Lekker. Thanks so much for making the time, Andries. Really appreciate it. That was a great conversation. Thanks for making the time.
My pleasure. Thanks, Mike.
To the listeners, I hope you got some value from today's episode with Andries Smit from Upside Savings. I definitely did. I think my main takeaway was just that reminder of you fail at business, you don't die, right? You fail at business, you wake up in the morning, the sun is shining. Even if you are in London, the sun might be shining. But life goes on and you can do it again. And decoupling one's identity from one's business is such a critical thing. And I think that reminder was fantastic. Thanks for listening to the show. And if you'd like to discuss your fintech project with a team of experts in design and development, head over to our website to book a call with one of our consultants. And I'll be back next week with another episode to explore the Fintech Founder Journey.